Good Thursday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, is for informational purposes only concerning the Market Chameleon tools and products. With that, D, good morning, buddy.
Morning, Will. How are you?
Good.
I'm going to share my screen here. And today, I think we are going to continue on the uh, same page where we ended up yesterday. We're talking about Nvidia and analyzing the single leg option trades. So it's on this page, if you type Nvidia at the top and you land on that page, on the side menu bar under options, just hit single leg dashboard and you'll get to this page. I'm going to close the menu to expand the screen. We covered the top portion yesterday and stopped, I believe, right here, volume by trader size. So let's just continue discussing what type of insights we could get when we're analyzing the single leg option trade volume. So these are option trades that don't include multi-leg or contingent trades. Okay, we're isolating them and analyzing them on their own. So we stopped yesterday looking by volume by trader size. And what this does over here is create a distribution of the volume based on the type of, the inference type of trader entering these orders and trading in the Nvidia. So we could look at smaller trades, trades that are maybe a one lot, a two lot, less than $2,000 in notional. We could also look at very large trades that are, 500, 1,000 contracts in the trade. It could be, 250,000, $500,000 in notional value just in option contracts. And then we have these in between. So this gives us an idea what type of traders are participating and what portion of the volume can be attributed to that type of trader. So we could see here that yesterday's trades look like, they're participation, all types of traders, small traders, retail traders that are not so small, but still fall in that retail category, proficient, and then large traders. There's volume from all types of traders yesterday. Maybe a bigger percentage of the volume, the larger and proficient traders would be responsible for, but it does show that there's participation, but by all types of traders in Nvidia. And it's a very popular stock now to trade, so it's not surprising. It's in the news. One of the busiest stocks that are traded, especially in the options markets. Then we covered quickly. I'm not sure if let's just cover this. We might have actually stopped over here yesterday, but this shows us a breakdown of the volume based on the options exchanges. So there are a lot of option exchanges, as you could see here. We've got Philex, Arca, Mercury, all the way, down to here.
I think Jeff said there are 18 of them now, right?
Yeah, like 16, 18. There are a lot of options exchanges, a very fragmented market, and you could trade anywhere. There are market makers and bids and offers in all these exchanges. And as you could see here, that in Nvidia, it seems like there was volume on almost all the exchanges. It looks like there's some volume on all the exchanges. Philex had the most, 12%, followed by Arca. And this just gives us an idea where perhaps, there is more trading, more order flow, maybe more limit orders on the books. and even maybe where your orders could get executed quicker because it has more order flow. So if you're self-directing to an exchange, you're trying to get a quicker fill or maybe perhaps a price improvement, knowing where there's more volume and more orders could improve your chances of a more immediate execution or a price improvement. So this is just a quick reference to see the distribution of volume by executed volume by exchange. So let's come down here, and now we look at the volume, single leg volume, and how is it distributed by expiration months. So options, they're not all the same. We have different expirations, we have calls, we have puts, we have different strikes. So when we look at the total volume, it's not like looking at the stock volume, because we have different options available for trading. So we want to look deeper in there, and here we could break down based on the expirations. And as you could see here in this chart, we have the expirations here below, and then the amount of volume traded represented by these bars. And the bars are stacked. The yellow represents the call volume, the blue is the put volume. So really quickly, we could scan with our eyes, and we see that December 13th sticks out, has the most volume, which indicates to us that a lot of the trading volume in Nvidia yesterday was the short dated options. These are expiring tomorrow, and just hover, you could eyeball it, and you could see that more volume traded in the calls than in the puts, which indicates to us that that's the traders preferred trading calls over puts yesterday. The next one down is December 20th, and you could see here similar situation, more volume in the calls than the puts. So looking at this, we could see quickly that trading in Nvidia is really concentrated or skewed towards the shorter dated options, and that more volume in the call options than in the put options. So mostly call options, and in the shorter dated options, we do see a little bit of volume if we go out further, but not close to what we see in those shorter dated options. So another thing that we see on this chart are these lines, right? And then we see two lines going out in time, and these dots. So let's discuss what that represents. Besides volume, a natural question would be, well, how is the trading volume impacting the option values, right? Is it pushing option values higher or lower? Just like if you were looking at trading volume in a stock, right? We could see in Nvidia, we could see the total volume, but how's it impacting the stock price, right? So we reference the previous day's stock price, typically to where the stock price is now, and then we know, okay, there's a lot of trading volume, and the impact on the stock was higher, right? More demand for that stock. So with options, I'm going to come down here. We referencing the price is not, it doesn't give you a accurate picture, because options are derivatives. So the price of an option, like a call option, could go down because the stock price is lower, right? So the stock price is lower, and the option has a delta, so the option price can go down. However, that doesn't mean that what's happening is that there are option sellers pushing it down. It's just a derivative, right? It has, time decay, it has delta. So the volume could still be that there's demand to buy that option, right? So how do we measure that? Well, we could use the option pricing model and reference the implied volatility, because the implied volatility is a relative value. And if we look at the implied volatility of the option and compare it to, the reference price of, let's say, the previous day, we could look at the change and make an inference that if the implied volatility is going up on the option, there's that the impact is that the relative option value is going higher. If it's going down, the implied volatility is going down, the relative value of the option is lower, just similar to the stock value. So how do we see that in this graph? Well, because we have different expirations here, we have different implied volatilities to reference. And so each expiration and at the money implied volatility, it could be different, right? So the implied volatility in December 13th could be lower than the implied volatility in January's. And the first thing we do is say, okay, let's plot the implied volatility for each month, okay, and draw a line through it. And this way, we could see what the implied volatility is doing as you go out in time. And here, that's represented by this gray line without the dots. So we could see that the implied volatility is increasing as you go out in time. It kind of peaks out here and levels off. And this appears to be also due to potentially an earnings event that's coming up, probably right around here. So this month is probably covering it, March 25th. And we could kind of confirm it because I'll go up here and we see that we're expecting February 26th, Nvidia to report earnings. So that's why we're seeing this pop in implied volatility between these 2 months. So that makes sense. And now we have that previous day's line. What we could do is reference today's implied volatility to see the change. And sometimes the lines will be very close together, so it's not clear if it's up or down. And to help with that, we created these little dots. And if a dot is red, that indicates that the implied volatility is lower from the previous day. If it's green, it means that the implied volatility is higher than the previous day. And then if you get this black one, that means it's unchanged. And looking at this, we could see that the implied volatility basically across the board declined. So it looks like the entire volatility structure shifted lower. Okay, the term structure shifted lower slightly from the previous day, the most in the front months. Okay, and when we look at this graph, now that we kind of know what it represents, then quickly we could just get those insights of what's going on in the options market. So most of the trading is in the front month, mostly call trading, and the implied volatility's term structure has shifted lower on the day. Right? That's a really quick assessment of what's going on with the trading volume and the option values. And we see a little pop there. So something probably some kind of event going on that the market is pricing in that will be covered by the March 21st expiration. So let's go a little bit deeper now into the analytics. And here we have this table. And this table shows us all the available expirations, options expirations. You could expand, it shows the top 10, but we could go show all of them. There are 21 different expirations available to trade in Nvidia. And they're organized by the shortest dated going to the longest dated. So you see December 13th, December 20th, December 27th, goes out all the way till January 15th, 2027, which if we go all the way to the right is 526 trading days. In addition to that, we have this column here. And to quickly, when we're analyzing options and then options expirations, it's important to know if there are special events that will cover that expiration that could create a catalyst event or more volatility, right? So if you think about like earnings, and earnings can create a more volatility because there's an unknown. They release earnings and the price of the stock gets repriced. So it's important to just reference if there's anything specific to the stock that could create more volatility that we detected, and that will be in this column, events. So a C will be a company event, and here you could see they're going to participate in the JP Morgan Health Conference January 13th, which could be important. Maybe nothing will happen, we don't know, but we know that there is a conference coming up, so it's something to pay attention to. Management could discuss a new product or give some kind of guidance or answer analyst question, and that could, impact investor sentiment. Earnings over here, February 26th, obviously that is an important event, and something, to keep an eye on. We could see here that, the implied volatility here is higher than the 1 month before. And the next column shows us the at the money IV. So this, you could see here, just eyeballing it, that the money implied volatility is different, as you go to different months. And it looks like it is climbing as you go up. As you go out further in time, it increases, which is, the same thing as we saw here on the graph. Now, when we analyze the options, what we did was we looked at it from so far term structure. How did the at the money implied volatilities change as you go out further in time? But the implied volatilities are different even within the same expiration based on the strikes. So not every strike, if you open up an options chain and you look at a particular expiration, you're going to notice that the implied volatilities are different as you move along strikes. They're not always like just, it's the same volatility throughout all the strikes. And those could look, the shape of that, we call it implied volatility curve or skew, can look different, and it could shift around. You could have, a downward sloping, upward sloping. You could have a smile with both wings going up. You could have a flat skew. So the shape of that could look different even as you go from one expiration to a different expiration, and it could move around. It could look different this week than it did last week. And to get a sense of what it may look like, what we did was create these two benchmarks. Instead of just like an at the money implied vol, we looked at if we did a straight skew, of an at the money, like let's say 37.5, and we ran 37.5 through every strike, and then we looked at the 25 delta put and 25 delta call, we said, well, what is the actual implied volatility relative to the 37.5 that had the monies? Is it higher or lower? And this will give us a sense of what the skew may look like. So we're looking at two more numbers to get an idea. Well, how does this skew look? So here, December 27th, you could see that the 25 delta put is close to where the at the money is, a little bit higher, and the 25 delta call, the upside call, is almost at 1% higher. So here's something interesting as we go out further in time. This looks like so far there's a reverse skew. Like look at January 24th. That 25 delta put looks like it's slightly lower or the same as the money, but the upside call is a little bit higher, 2%, which shows a skew with a bias towards the upside. Mean that there's more demand for upside than downside. Okay, so let's just take a look. Let's see how that looks like. I'm going to click on the January 24th expiration here. And here we kind of get this chart, right? And this chart shows us the different strikes. And it's similar to what we saw over here. Okay, it's a similar situation, except below, these are different strikes for the same expiration, January 24th expiration. And let's see, where's that the money? The stock is 140, right? So let's look at the 140 strike. It's over here. So you could see here, the 25 deltas. I mean, it looks kind of flat. The 25 deltas are probably like around here somewhere. So, it does go, as you go out further, strikes, they do start going up. So those tails are moving higher. But it's kind of flat, probably right around at the monies. But what this shows us is the distribution of the single leg trade volume within January 24th expiration. You can see the biggest volume was in these 136 strike puts. So that stands out. And then as you go up in strikes, mostly call trading. And if we just looked at the implied volatility, it looks like a little bit of a mixed bag. Like around at the monies, the implied vols are lower, but there are some strikes here that look like that they were lifted on the tail end to the downside. Again, it's a visual. Really quickly, you're just painting a visual of what looks like what is the trading volume and the option values within this expiration. Let's go up a little bit, and now looking at this table, because obviously, why the reason we have these benchmarks here is so we could see them kind of all in the table without having to click on each one of these expirations. If we compare, so these are the changes. So what we did was look at the values, at the money IV values, and the relative values of the 25 delta put and 25 delta call relative to at the monies. So the next question is, well, how did these values change, right? Because these aren't, so far, these aren't changes. These are just relative values. What do they look like? But what if we wanted to know how did they change on the day, just like a price change? So we'd have to find those same strikes we're referencing and see what they were the day before to what they are now. So these are comparing strike by strike, okay? Not delta by delta, but strike by strike. So whatever this at the money IV is today, whatever strike we're referencing, we're looking at that same strike yesterday to see the change. And you could see here that pretty much it's gone down across the board. And then we do the same thing for the 25 delta put and 25 delta call. If we looked at that same strike from the day before, what does it look like? It did. And you could see that almost everywhere across the board, all the implied volatilities are lower. So looking at this table, it looks like the term structure shifted lower, and so did all the strikes, the skews within the expiration also shifted lower for the most part. Okay, so implied volatilities were like lower across the board. That's what this table is indicating. Then we have a couple more stats here to reference. One is just looking at the actual volume for each expiration. And you could eyeball and just see that, yes, December 13th sticks out, 1.5 million. You know, the next one, December 20th, 500,000. And the other ones kind of taper off. If we wanted to get a sense of, you know, that's looking at the raw data. If we wanted to see what percentage of the volume in each expiration represented the percentage of the total, here we could see that 52% of all the single leg trades were in December 13th expiration, 21% were in December 20th. So this is just converting these raw numbers to percentages. It's easier to see by percentages, you know, where more of the volume is concentrated. And then next to it, we see the open interest for each of these expirations. Another breakdown is if you're looking at a specific expiration, let's say December 13th, and we wanted to see the breakdown call percentage versus put, we could see 66% of the volume were in the calls, 34% of puts. And then we kind of know what's going on within that expiration when we look at which contracts are the traders preferring to trade. You know, so in these cases, more call volume than put volume. And lastly, this days left, trading days left, just lets us know in this expiration how many trading days are left, as just a quick reference. So, well, I'm going to stop there. I think I covered all the data points.
Yeah, that was awesome. As always, Steve, thanks so much. Very helpful to the Chameleon community. Thank you for bringing all the information to them every day. Remember, please give us some thumbs up. Thanks, and follow us on YouTube. All right, D.